right, welcome back now to our third session of this June 2016, and we are recording. So people will be joining the room shortly, where we are going to change up our examiner's answers and say that we are buying the dollars at the higher rate for dollars, or at the rate of 1.1 or 5 something. I lost my rate. 1.1585. 85. This was dollars per euro. Or as we converted it, 0.8632, was it? Yeah, 8632 dollars per euro. No, euro per dollars. Right, so convert 674 to 50 times 1.185. You could probably write out the working. Somebody give me a number. Oh, where's my chat box? Yeah, somebody throw the number at me, please. 674,250 times 1.1585. Right, 781 119. 119. Right, so let's see when we do our conversion in the end to get our effective rate, if it comes back closer to our value here. So this is what I was looking at. My 1.1249 wasn't lining up with the examiner's answer. Now I'm finding this error. And if I do convert in the end and get closer to that, I'll just be all the more happy. So let's see if that happens. So we have the number of contracts, we have the premium cost, and now we can find out the cash flows from exercise. From exercising, we will get from 186 contracts, 86 or 85, yeah, 186 contracts. What will we get? 186 times 125 thousands of dollars. Hold on. This premium cost up here. $674. Hold on. I mixed up some currencies here. Up here, 186 contracts will cost a premium. If this is dollars multiplied by that, what is this 674? This 674 is not dollars, is it? This 674 is euros. Is everybody clear with that? Change. Right? Because we're multiplying by euros over dollars here. That knocks off the dollars, leaves us with euro. We now have to pay this amount. Maybe that's why examiner answer did it the other way around. Let me check back my logic here now. This is not an amount of dollars, that's an amount of euros. So we still need to go to the bank and sell these euros to the bank. The bank still needs to buy these euros from us. So, my logic is not changing. So the bank is buying these euros from us. We have to pay this amount now. We have to buy the dollars to pay that, and converting this into dollars. Yeah. All right. So instead of saying this amount, we have to pay this premium now in dollars. Now in dollars. Now that, however, that's another funny thing. That's, however, is the rule when you don't have contracts for dollars. But this time we have contracts for dollars and the premium was in euros. Maybe if you could have paid the premium in euro, it wouldn't have made a difference. But we're just following the methodology, which is what the examiner's answer did. So let's continue. Again, I'm sticking to my guns here. We have to pay this premium in dollars. We have to buy the dollars to pay the premium. And in selling our euros, the bank will buy our euros low, right? So that's where the 1585 comes from. So I could still note that here. That is, the bank buys euros low. So premium cost now, so many euros times that. So many euros times that will now give us a value in dollars. And really, from exercise 186 contracts, just give me 1 second to deal with another phone call here. Right, my apologies there. That's another student. He has exams tomorrow in another program. So, yeah, trying to help out there. Right, back to where we are. So from the 186 contracts, this will get us 186 times $125,000. How much dollars will that get you? Should put that around. $23,250,000. Now, this would effectively be our receipt. And up here, our premium is our cost. So therefore, what would we do to these two values? Net, is everybody following there? Net receipt from options hedge. Again, I could scoot this around, put in an equal sign there. Equals 23,250,123 minus 781,119 22. Let's see if I can make this any better. 0 decimals. 224,688,8 1. So what does our answer sheet say? Nets off with a little 5,000 difference. 22472. 8. Right. So again, 0.86. We could also identify our overhedge as we had, or in this case, sorry, underhedge. As we chose the 186 was when there was that small bit outstanding. Yeah, let's try that and see if it lines up with the examiner's answers. So 20 million euro compared to our 23,250,123 dollars at the exercise or strike price of 0.8600, and that's an amount of euros per dollar. What would that get you? $23,250,223 times 0.86 at 19,995. So while that would require so many euros, how many euros is now unhedged? Same amount as the examiner's answer sheet. That is 5,000 euros unhedged. So if we have to convert that at forward 1.55, the same rates we use up here, the forward contract. So again, this is what backs up what I said earlier. It did use a low rate in the forward contract, 1.559. So why it's not using a low rate in the spot market, right? So 5,000 unhedged, convert at forward to give receipt of 5,000 times 1.1559. What's that gonna get us? Again, an amount of dollars. So up here again, put a double line or bottom line. Yes, definitely immaterial, and I'm just doing it definitely. You could definitely leave it out. At this stage, because I changed the other bit, I just wanted it to put it in to compare it. Yeah? So very good point, Anita. So 5,000 times 1.1559, 5,779.5 or 5,780. 5,780 net receipt again being equal to, so yeah, definitely in the exam you don't have to do it. I'm just doing it here for the, definitely put your note to try and see how this compares. Right, 22474,661. They have 22472. So that's about a $2,000 difference. But this now is the final, this is the real thing that I want to do here, right? So if you have time to go through all of this cash flow section, you could still come back now and say, thus, I'll go back to using bold here, thus the effective rate from the options hedge is, we want, how did we compare all our rates so far? Our forward hedge to our futures hedge, we were comparing in the values of dollars per pound. Yeah, dollars per pound there, dollars per pound here, 1.561. And this is what caused our futures hedge of 561 to be larger than our forward hedge of 1559. So 1559 compared to 1561. 61 was higher, and of course the option here was lower. Let us see now what our net value is. And again, I came up here to identify it's dollars divided by euros. So let's do that here. Dollars per euro. Net receipt over here is dollars. So this is dollars. So how do we get an effective rate? Take all of the dollars we found or got, 22,474, excuse me, 661 dollars divided by the amount of euros we got, 20 million. Somebody tell me what's my effective rate? 1.237. 22,474, 61 divided by 20. Yep, 1.237. 1.1237 again, dollars per euro. Right, that doesn't seem to be awfully close. Well, it is close, but it isn't as close as I would have liked it to this value that we have up here, 1.1249, right? So 49 versus 37 here. The examiner's value got me 33, which is actually a bit closer, but 37 is still not 49. However, do we see the closeness? It's still 1.12 compared to up here, which was 1.156. So this is where I say, by simply identifying that you are purchasing these dollars at the 0.86 and you have to pay this premium of the 0.29, and those two will add to give you this net rate, right? That could be something that you can use to compare rather than stressing out over all of the cash flows, right? The only other thing I would have done in addition to this working is compute the number of contracts and leave it as a note to the examiner right here that this method doesn't take account of the fact that the exercise, that the premium is required to be paid now. Even the previous answers have made an error with that in terms of calculating that premium cost. So we can just leave that out entirely. We know that the premium is going to be on a per dollar basis. And 1.237, 1.249, they're all close to 1.2. So this is where I would sort of advise you, you can do this to help save some time. The only additional thing there is probably try and work out the number of contracts. Can you do that without too much headache? What did we need to do that? Once you identify the, all we did here was take the dollar value, divide by the exercise price, divide by number of contracts, yeah? So that's a nice short working you could have done to collect that mark on number of contracts. And that, together with this statement up here, is where I really would like you to leave your options hedge. All right, is everybody okay with that? Any queries there? So the cash flows almost proved the 1.1249. We got 1.1237 instead. So why do all that stress when you have something that's very close to it? And again, what we can do is look back through your other option questions. So we could probably do that briefly tomorrow night, right? So I'll pick a number of the option questions from the kit. Once we could find other questions with currency options and see if this methodology gives us consistently something close to what net value could be. Everybody okay? Any queries here? Make sure everybody's following the logic. And again, the detail, of course, since I had to email out that question paper, I could email out the answer sheet. I'll do that right after our session here. All right. So once more, let's go. We still have other bits. Now there's one more bit with a calculation. The rest of it is some wonderful theory, right, that I need people to be aware of. So, choice. Are we going to go through the wonderful theory, or will you read that through on purchasing power parity, the issues? I'm looking at the examiner answer here, and they actually did the issues first. That's so wonderful, right? So that's just proven my point again, all right? So that you will be in the exam, you want to be properly prepared so that you can deal with all the theory, all right? So let us try and shoot these calculations out. I promised my other student there that I will deal with them by 10:30. So let's see if we could complete this other bit of calculation. There's just one other bit. Actually, I'm seeing some other bits there with the final valuation. All right, let's see what we can do. So let's begin. So we are looking at this dividend capacity business. Let's see. Where is that? B part 1. Estimate the company's dividend capacity as 28 February prior to investment in this large project. So let's try and get dividend capacity. How do we identify that? So prior to the investment, right? So looking up here at what we have, dividend history, expected dividend, cost of capital, and further up here. This is expected income and cash flow commitments before taking on the project. So we have all these sales. We have this working capital for the coming year before, again, all of this is before the large project. Operating margin 15%. We have sales growing by 8% next year. We have the working capital. We have depreciation, investment equivalent to the depreciation. Remember we saw this when we did the study school? What does this line, an investment equivalent to the amount of depreciation, mean for us? As it is already included in the operating margin of 25%. nil effect. Very good. And again, nil effect only because of this line here. Nil effect because it is already included. If it wasn't included, then we would have been in trouble. Everybody okay? So the idea is because it is included, it's a non-cash flow, so you should take it out. However, you would then need to put in the investment. So if you take out the depreciation, put in the investment, both of them are equivalent, then it's effectively a nil adjustment. Is everybody clear with that? Can I see by a type of yes? Not everybody's clear with that. As Kanisha mentioned, very good. So, note 3, point to investment in additional non-current assets. Fine. For every $1 increase, 8 million additional investment in other small projects. So wow, all these additional investments now, investment. Will those be cash inflows or cash outflows? Overseas subsidiary coming in, right? So outflows, very good. And you have your subsidiary stuff. And what is dividend capacity? How do we get to this thing called dividend capacity? Any ideas? Each tool include variable costs and so on and so forth. Sale of equity, that's a sale of equity. What are we going to do with the dividend capacity? Dividend history, expected dividends and cost of capital. So we have those issues, total dividends, dividends growing and so on. Expected dividends and dividend growth rates if the large project is undertaken. So this is for the project now. It's expected that dividends will grow at a historic rate if large project is not undertaken. So we can have the old growth, but coming back to describe what is dividend capacity? Can somebody tell me? Do I have to take you all to your manuals again? Dividend capacity, or somebody could Google it quickly. What is this dividend capacity thing? So we have all this wonderful dividend history, and then above here we were reading all this nice stuff about expected inflow, income and cash flow commitments prior to the project. Prepare discussion paper, following information to assist in preparation of discussion paper. We have the capital structure, so many equity, so many shares, and we are stuck with this requirement asking us again, B part 1, estimate the company's dividend capacity, February 2017. So this is the stuff that's ending us on February 2017, and again, prior. So while this is what we're looking for, come on, dividend capacity, page 51 and page 137. Two page references. On page 51, dividend capacity says we are going to take FCFE is a net income. Estimation of dividend capacity of a firm dealt with in chapter 4. The definition, it's your free cash flow to equity. Your net income, EBIT, minus interest, minus tax. Add back the depreciation, less the total investments. Any debt issued, you're going to add that on. Any equity issued, you're going to add that in. So it's basically Free cash flow to equity. Anita made it kind of fancy there. It is not the FCFE add anything, Anita. It is the FCFE full stop. All right, following that difference there, Anita. Our 10-minute warning is up. So in 10 minutes, we'll get a new room. And hopefully that'll take us to 9:30 when we'll be finished. So page 51, taking our net income as net as we can get. And we have up here sales 8% from 3 million, and then operating profit. So we could start with operating profit and then keep going down to do all the adjustments, right? So potential dividend that can be paid, yes, Kinisa, but potential dividend is paid from what? What do I pick up to give these people and call it dividends? What's the C word? 4-letter C word, which is not vulgar, but that's actually a good word. Cash, very good. So that's why it's FCFE, right, Kanisa? The free cash flow is what you can now give away, the maximum dividend capacity. Of course, you should not give out all, right? It's a capacity, it's how much you're able to give. So let us, without further ado, start crunching some numbers here. Where do I put this? I could put it below the question. I have enough space there. All right, so B part 1. B part 1, dividend capacity. I.E FCFE computation. So we want to start with some sort of profits or some sort of net income, which was equal to what were we given on top? Operating profit. Come on, somebody crunch that for me. What's our operating profit? We are starting off with what? Profit is going to come from sales. Everybody following? So profit's going to come from sales. Sales is 8% growth from the current of 300 million. So you're going to take 300 million, grow it by 8%. That is sales. And then we're going to punch out of that. Hey, Amara already punched it. Then we're going to punch out of that 15%. Everybody good? And that will be our operating profit. Thank you very much, Amar. Everybody check that over, make sure this calculator is working correctly. Right, 48.6, and we are working in millions to save us numbers and time. Right, so up here, oh, down here, dollars millions. So, yeah, make sure everybody's following along there. And 300, that was 300 what? Was that 300 in millions? Yeah, 300 in millions. That's 300 times 1.08 times 0.15, 48.6. Come on, the rest of your cash adjustments down the line, probably punch 2 decimals here. And all the way down, 2 decimals. Net income, what's the first thing we could deduct? So, is that the only thing we'll have as net income? Any other expense that we could deduct? Expense to get the net income. Apart from all these investments, everything is an investment. Working capital, any other profit item before we get to these investments? Again, back to my page 41. Was it 51? I lost my definition. Right. So net income is EBIT. Is there any interest and any tax that we can deduct? To get to net income. Right, so following page 51, we need to look for interest and tax. Come on. Interest. What do we got? Where do we got interest? Not in these four notes. 1, 2, 3, 4. Somebody shout out the interest at me. It's right in front of us. Yep, it's 5% right there. So this 5% here of our 70 million bonds is some interest we gotta pay. Somebody shout out the tax. This paragraph here. Lyrical pays tax at 25%. And Pontac, we're gonna deal with Pontac after. Right, so let's go. Interest and tax, operating profit. Less interest. 5% times 70,000. Come on, we could work faster than this. That's 70 in millions, yes. Equal 0.05 times 70. What do we got? 3.5 million. And tax. Well, we should less that and get some subtotal. Up. Equivalent minus that. 45.1. Good. 25%. I could just say at 25%. Punch that in. $11.28. Good. And less than that will get us now 3.83. Very good. Well, Excel has given me 83. I should. Oh, 3.83. I'll look without about this. 3.83. No, 82. Right, what next? All of those investments. Investment. Changes in working capital, capital investment. I don't think there was any new debt or new equity. Question sort of said that. So let's deal with our working capital. That's working capital increase. Remember, it's increase only. So what do we got? A 10-cent investment for every dollar increase in sales revenue. That is me. How are we looking at? What was our increase in sales revenue? 8% by 324. So the growth was 24. 8 is 24, yeah. So 1% times that, or 10 cents. 0.10 times 0.08 times 300, 2.4 plus 0.1 times